According to industry group estimates, buy now, pay later companies are now holding over $500 billion in debt. This exact figure is more difficult to quantify than metrics like total credit card debt, as these firms are not subject to the same strict reporting requirements for their lending activities. In any case, this is a particularly alarming sum because buy now, pay later loans are designed to be very short-term, typically paid off within 8 weeks through a predictable installment plan. However, recent research and even admissions from the companies themselves have confirmed what many suspected. People are not consistently paying off their accounts. Instead, they're leveraging these services as a new tool to extend their budget when their funds run low at the end of the month. The majority of the leading buy now, pay later companies have been around for less than a decade. In that short period, they have managed to expand at an incredible pace, fueled by a mix of plentiful investor capital, a casual approach to regulations, and a service that appealed to consumers who, for various reasons, wanted to avoid a formal credit application. The core argument was that these companies were not issuing loans, but simply allowing people to break down a purchase into smaller, scheduled payments. If all went according to plan, users would not have to pay any interest. But now, after distributing these quick, easy, not loans to anyone with a smartphone, these companies are acting surprised that the debt isn't being repaid. While consumer debt defaults are rising across the board, buy now, pay later carries its own set of risks that could make the situation far more severe than just people struggling to finance small purchases. Dramatic. Why is buy now, pay later so addictive? I'm using Klarna to pay for these Chris Brown tickets. I don't care what nobody says. Being under financial stress takes a lot of time, a lot of planning. I am Afterpay's #1 consumer, #1 fan. I don't know what it is about a paying for, but I can just never resist. I will Afterpay it because I feel less guilt. Analytical. On the surface, buy now, pay later products don't seem fundamentally different from credit cards. Both let you buy things now and pay for them over time. Both provide interest-free periods if payments are made on schedule. And both have been eagerly adopted by retailers because they encourage customers to spend money they don't currently have. It's also true that both financing methods come with very high interest rates and fees for late payments. And while BNPL companies often downplay these risks, I hope it isn't shocking to you that delinquent, unsecured consumer debt is deemed very risky and thus carries a high interest rate. Intriguing. Yet for financial tools that appear so similar, there is one major difference that is often overlooked. Factual. According to data from the Federal Reserve, credit cards are among the most profitable products banks offer to their customers. Even when accounting for interest-free periods, banks earn returns on credit card lending that are 4 times higher than on products like mortgages, commercial loans, or traditional personal loans. Contrasting. Buy now, pay later companies, by contrast, have found it incredibly difficult to turn a profit at all. In fact, most of them have been posting spectacular losses. Specific. Based on public financial records, Affirm lost nearly $500 million last year, which was actually an improvement on the prior year's loss of almost a full $1 billion. Explanatory. It's harder to get precise data for companies like Afterpay, Klarna, and PayPal's Pay in 4 because they're either privately held and don't disclose financials, or they've been acquired by larger entities, which obscures their losses among profits from other business divisions. Critical. Klarna, for instance, has raised significant capital from investors like SoftBank to grow its operations. Skeptical. The company has claimed some profitable quarters, attributing it to their use of AI to reduce customer support costs. Revealing. However, much of this was propped up by low borrowing costs, an overly optimistic assessment of customer repayment rates, all while ignoring other operational expenses. Damning. The company's actual result for one recent quarter was a loss of nearly $100 million, double the loss from the same period a year earlier. Disbelieving. In what was supposed to be the golden age of buy now, pay later, the industry leader has had to delay its IPO because the viability of its entire business model is in question. Emphatic.
These losses are happening across the industry, even though buy now, pay later companies typically charge merchants a larger percentage of sales and impose higher effective interest rates on late payments. Accusatory. And yes, even if you don't use these services yourself, you are still indirectly paying for them. Intriguing. So it's time to understand how a seemingly predatory business that undermines the finances of millions of people globally can't even manage to be profitable for itself. Informative. The intended business model for buy now, pay later companies was to generate revenue by charging merchants a higher than average fee. Factual. Mainstream credit card processors like Square or Stripe typically charge merchants between 1.5 and 3.5% of a sale. Contrasting. In contrast, according to a report by Merchant Cost Consulting, BNPL companies have been charging retailers as much as 8% on each transaction. Confidential. While major corporations like Walmart and Amazon can negotiate lower rates, these deals are confidential. Problematic. For many retailers, an 8% fee can represent their entire profit margin on a sale, making it unsustainable. Complicated. The issue is that their agreements with BNPL providers forbid merchants from passing this fee directly to the customer. Analytical. This leaves them with two choices: either make zero profit on sales made through platforms like Klarna, or raise prices for all customers to absorb this new cost. Observational. A third option would be to refuse to offer these payment methods, but retailers are hesitant for a few key reasons. Assertive. First, buy now, pay later users are ideal customers from a sales perspective. Industry data shows they are typically younger than traditional credit card users, spend more impulsively, and have enhanced purchasing power due to the ability to split payments. Authoritative. A Harvard Business Review report found that after adopting buy now, pay later services, consumers were 17 to 26% more likely to complete a purchase. Staggering. Not only that, but their average order size was 10% larger, leading to an overall 30% jump in discretionary spending. Concerned. A 30% increase in spending on non-essentials is not something the average household can currently afford, especially for the demographics most attracted to buy now, pay later. Comparative. For those who can qualify for and responsibly use them, credit cards offer better overall value with more flexible terms, superior reward programs, and the ability to build a credit history. Critical. They're also more heavily regulated because they are officially classified as debt. Cynical. BNPL firms have so far avoided this classification, meaning they operate with less regulatory oversight and can extend credit to individuals who might not otherwise qualify. Balanced. This isn't to say credit cards are perfect. They can also enable people to spend money they don't have on things they don't need. Contrasting. But there are more rules around responsible lending. Troubling. Since BNPL applications don't appear on official credit reports, it allows for some risky financial maneuvering. Illustrative. A person could get a credit card and apply for multiple BNPL loans simultaneously, with neither lender being aware of the other. Explanatory. They could then use the credit card to make the BNPL installment payments, extending the time between the purchase and when they actually need the money by over 4 months. Skeptical. While a finance enthusiast might justify this with arguments about the time value of money, the reality is that people are doing this either out of extreme financial irresponsibility or because they see no other option. Empathetic. With the cost of living outpacing income for many, people are using these financial gymnastics to stretch their finances as far as possible. Resigned. Buy now, pay later has become another instrument to postpone a financial reckoning. Revealing. An industry survey by LendingTree revealed that groceries are one of the fastest growing categories for these services. Acknowledging. So while it's easy to label Afterpay users as reckless, and there certainly are people being irresponsible, much of this spending is driven by people simply trying to keep up. A 2023 Fed study found that over half of BNPL users took on these loans because it was the only way they could afford a purchase. Conclusive. This surge in spending, whether responsible or not, is a powerful motivator for businesses to accept the massive commissions these BNPL companies charge. Theatrical. Jesus, is this stuff regulated, or are you guys, what are you doing here? Sort of. Jesus Christ, the spreads on these are huge. 50% commission? Help for what? It's our markup for our services? Anyway, if all of that wasn't good enough, these services gather vast amounts of data on their customers, acting as marketing platforms for brand partners by pushing tailored deals and limited time offers directly to individuals. Historical. In their early days, companies like Afterpay operated heavily as sales platforms, hosting